Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. What a week we have had. We've had our ups, we've had our downs. It's been an emotional roller coaster, folks, and it's time to have a look at where we land because for next week, we are looking at what is going to be the really big set of event risk developments in this story. So let's jump right in. What we saw overnight here was really a very impressive outing from the European Central Bank. The president there, Christine Lagarde, threading the very fine needle that is the give and take between banking stress and the need to fight inflation. And she came out confident, and the government and the governing council came out confident. And they said, we promised you 50 basis points. We're going to deal with the bank issue if it arises, how it arises, in whatever episodic way we need. There will be liquidity, but here's your 50 basis points, and inflation is too high, and we're going to keep going. And the market liked it. The market didn't collapse. It didn't run for the exits thinking central banks have over-tightened. On the contrary, it took that as a kind of respite, as a kind of confirmation that central banks have this thing in hand. And they need to be able to walk and chew gum at the same time. They need to be able to, on the one hand, funnel liquidity into this bank or that when necessary, while pulling liquidity from the larger economies to reduce inflation. This is a very, very masterful performance, given the circumstances, and it sets us up for what is the big announcement in this story next week, that of the FOMC. And so what we're going to do here is we're going to look at how this sets us up for what the Fed might do and how they might do it, and also for how the Bank of England might then wade into those waters post-Fed with their own policy announcement, and to what extent that might take us into one direction or another, markets-wide. So let's look at some of our favorite charts here and get the lay of the land on the Fed and where it's going. Economic data continues to surprise on the upside in the U.S. Better jobless claims today, better housing data today, giving us a still higher and a still impressively steep incline on this economic surprise index. So this is from Citigroup. It measures the performance of U.S. economic outcomes as relative to baseline expectations. So your big aggregators of expected outcomes that poll the major banks, call it Bloomberg or Reuters, or certainly a whole range of others. They go and they talk to all of the big market economists, the official forecasts from the banks, the big research houses, the funds, and they compile these median forecasts that serve as the anchoring for market expectations. So when we say XYZ earnings announcement came in better or worse than expected, or XYZ economic data came in better or worse, that's relative to these compiled expectations. What this index does is when the data comes in better, it goes up relative to those expectations. When the data comes in worse relative to them, it goes down. It's also very helpfully scaled by volatility. So it goes up more when the announcement moves markets as opposed to not. And of course, vice versa on the downside. What we can see is that leading into this recent turmoil with SVB, with Credit Suisse, with Signature, Silvergate, leading into all of that, the main story was the U.S. economy started to really heat up in February. And we had much better economic data, and that trend continues. What that's done is it's shown up in inflation expectations. And here, as ever, we're looking at the 2-year break-even rate. This is the difference between nominal and real bond yields. When you subtract one from the other, it gives you the inflation adjustment that takes you from nominal rates, which don't factor out inflation, to real rates, which do. So when you subtract one from the other, that factoring out of inflation gives you a number. And that's the market's inflation expectation. In this case, we're looking at the 2-year break even because that's about within the Fed's policy outlook window. And you can see that this month, the last yellow bar there is March. This is monthly data. With all of the recent consternation, you've only come in from 3.2 in February to 2.7 currently on the 2-year break even. So you're averaging about 3. Which means that you are in a situation where this heating up of the economy, February through to now, is saying the Fed is on track to be about 100 basis points over its target by the time it wants to be at that target. So not only has the Fed not over-tightened as far as the bond market is concerned, it's under-tightened and needs to keep going. You can see that with about a 2-month lag, these expectations and break-even rates lead the major measures of inflation, the PCE and the CPI. So there is a sense that the pullback that we've seen is already essentially gamed out, and that the next leg for where official inflation data is going is higher. And what the Fed needs to do is it needs to change that course. We can see, of course, the shape of the yield curve has changed significantly, but it hasn't changed terribly as relative to the last time that the Fed spoke. So the light dotted line there is a week ago, which you can see is a much more hawkish set of expectations. We're looking at, on that curve, a peak in rates at about 5.5. And we're looking at it in about, let's call it September. Now, we have a peak that looks to be happening much earlier. It looks to be happening within about 3 months' time, so call it mid-year, call it June. And it's occurring basically at 5%. 4.95 seems to be that range of 4.75 to 5. What's interesting is this is basically the same curve with very little difference, certainly in terms of the terminal rate, than what we saw in the markets when the Fed last spoke to us at the beginning of February. There was an inordinately long gap here between February's FOMC and the one next week. And obviously, we've taken a very circuitous path here from then to now. But as you can see, the peak is about the same. And not only that, but it's closely in line with where the last set of Fed economic projections, now going back to December, is the last time that was released, and we'll get a new set next week. That happens quarterly. The projection there was 5.1 from Fed officials on the terminal rate, which is awfully close to where we are now. So lots of moving and shaking back and forth here over the course of nearly 2 months. But we're kind of where the Fed last left us. The key difference is, whereas before it looked like we were going to linger at that terminal rate for at least a quarter, now it seems like we're moving right into cutting mode once we hit the peak. And so you can see from these baseline expectations as they stand currently, a 25 basis point hike is almost baked in. So we're looking at about a 77% chance of a 25 basis point hike. You can see that's in that percent hike cut column. And then the next one over shows you the implied rate delta, which is 19 basis points. So most of a 25 basis point hike. We can see that we have that hike fully baked in come May. So either we're going to get a hike this go round or May, it seems. And it already is starting to unwind such that by July, that hike is gone. So you can see we are standing there at essentially zero change in rates as relative to now. And so then, as you look out through the rest of the year, we have cuts. And we are actually expecting to have at least 25 basis points approaching 50. You can see in that December column, looking at the number of hikes cuts column, the one second from the left, negative 1.65. So what that's telling you is we have one cut as relative to where rates are currently, and 65% chance of a second one. So in other words, down 25 basis points at least, and a 65% chance of being down 50 relative to where we are currently, which you can see here, the policy rate is 4.6. So we're in a 4.5 to 4.75 range here. So we're looking to essentially be back at 4 by the end of the year, maybe 4.25. So the markets have a perspective on this that although inflation still looks a bit hot, we are basically where we were, let's call it a month and a half ago, maybe a little bit more. And that essentially all the Fed needs to do, if the ECB is the example du jour, is keep confident and come out and say, look, we've had a lot of back and forth. The markets are obviously more reactive than we are. So we're on course. We told you back in December there's fine tuning, and we're going to move to a pace of 25 basis points because we think we're getting close to something that feels like enough tightening. We're going to move more gradually. So it looks like the market is set up to digest that kind of a thing. And then, of course, we'll have to see what the summary of economic projections says, because there's been quite a bit of chatter from Fed officials, including Jay Powell himself, saying, well, the economy has turned out stronger. We just saw that his performance in February and so far this month. So maybe that terminal rate goes up in terms of expectations. And we'll see how the markets digest this. But the way things are set up right now, it appears as though a level of normal as relative to the last Fed policy announcement seems to have settled for the most part. Now, the Fed is not going to be the only central bank in the hot seat. We also are going to have a policy announcement from the Bank of England, as we mentioned earlier. And here, this will be very important, certainly, for the UK, very important for the British pound, very important for UK economic conditions locally and UK shares, but tremendously important for US stocks, global stocks, the direction of every major currency, the direction of crypto, because what this will be is the first central bank to test the waters after the Fed. So just like the ECB was first to test the waters after the banking crises, and boy, did they nail it, now we're going to have the Fed attempt to do the same. And the Fed arguably is more consequential than almost any central bank, I would argue every central bank, because 80+% of global commerce is transacted ultimately in US dollars, according to the Bank of International Settlements. And so when you raise the cost of borrowing dollars, you raise the cost of borrowing everywhere, point blank and period. Depending on how the markets then react to what the Fed does in moving that needle, which is arguably the most important needle and has been the most important needle since the middle of 2021, when the Fed unveiled its intentions to launch on a significant rate hike cycle, the Bank of England will be the first to put a toe in that new environment. So what you see here is that, as with most central banks, rate hike expectations have really been hemmed in since last week. You can see last week's curve in the small dots there, much more hawkish than where we are currently. There's much more of a flat curve. That's another interesting thing to note here. The curve for the Fed still a little bit more humped in terms of a quick move higher and then a quick move lower. The curve for the Bank of England has flattened a good bit, but it is still more hawkish than what it was when we last heard from the Bank of England, which was also at the beginning of February. As a matter of fact, all three of these central banks, the Fed, the Bank of England, and the ECB, reported within about 48 hours at the start of last month. And so what you see here is the markets expect a shallower path, but they expect rates to linger at higher levels longer for the Bank of England. Needless to say, though, the pickup in financial stress has had its due. It has taken its toll. So here you see the Office of Financial Research. This is an agency of the U.S. government. Their financial stress index has clearly surged here in the wake of all of these developments in the banking sector. And so rate hike odds have significantly declined. For the Bank of England, you can see the peak in rates as they present themselves seems to be somewhere around the August-September area. If we go back to the yield curve here, you can see the peak is 6 months out from now, so that's about September. And unlike the Fed, there is a policy announcement in August, so somewhere in that 432, 437 range seems to be where rates are going to peak now. And you can see for those months, for those meetings, you've moved lower as you have really across all the major central banks. And you've shaved off seemingly about 50 basis points from where these peaks were before last week's stress. So now, if you look at what's baked in, we have a 62% chance of a hike. We get that hike seemingly by May already baked in. So you can see in the implied rate delta column here for the BOE, come May, you're at 27 basis points. So that hike is in. And from there, it looks like you are done. You never really get to 50 basis points through the rest of this until you turn now at this stage by the end of the year. But here, it looks like we are going to hold that hike. So there's a bit of a probability that you'll get more. You can see June, August, September, you have about a 50-50 chance of a hike. So you can see in that number of hikes cuts column, you're looking at 1.4, 1.47, 1.49 over those 3 meetings, which is telling you that the one hike is in, and there's about a 50-50 shot of another one somewhere in there. But then you're done. And you take that hike away come, it looks like, November, and by December, you've only had the one hike. So the markets are still kind of flirting, it looks like, with how reactive the Bank of England is going to be, but ultimately they expect one hike through the rest of this year to be the net outcome. Which is an interesting situation in the UK because you can see here, economic data has been rapidly improving relative to expectations. You can see most recently it's above zero, the economic surprise index here. And much like in the US, it is accelerating in that direction. So economic data is doing progressively better here, it seems like, than expected. And shock of shocks, the turn is in February. So just as with the US, you have a similar story where the pressure is coming in here. And if you look at where you are on economic growth in the UK, that makes sense. You can see that there's been an upturn in activity. Manufacturing is still in contraction territory, and this, of course, is our favorite set of PMI indicators in the logic of the way that these indices are set up. 50 is the neutral line. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. So for manufacturing, you can see you're just about back to neutral, 49.3 on the last reading. But for at least 2 months, the pace of contraction has been slowing. So things are ostensibly improving. As with most major economies, though, services is the big sector here. And you can see that the composite and the services indices basically track tick for tick. And both of those are well over 50 now. The composite number 53.1, pointing to a return to growth and a brisk one at that. So what you're looking at here is ostensibly pressure on the inflation side. There is a bit of a respite here. If you look at that same calculus for the inflation dynamics as we did with the Fed, where we look at the break-even rate relative to CPI, you can see it holds for the UK as well. Only for the UK, the deceleration in inflation has been much more significant, and you are now down from 12 to about 3. On the break-even rate here, and that's of course relatively encouraging. So what you see is there's about a 7-month lag here, and we're using a 5-year break-even because there's not a liquid 2-year, and so what you're ending up with then, just to kind of fully unpack what the market is telling us, is that over a 5-year window, we're going to see inflation, which may have established some kind of a peak here at about 10.7, 11%, give or take. The last peak number there from March at 11.1. So if we, in fact, have that peak in, then the break-even would imply that over a 5-year window, we're going to come into 3 or so. Now, that's, of course, much better, but it's not quite on target. And so maybe the Bank of England needs to do more, but as it stands at the moment, it does look like the market has confidence that they're heading in the right direction. And so maybe the Bank of England can get away with doing a bit less without setting anything on fire. However, it does look like the economy is improving. It does look like economic data is getting better, and the pressure may be building. So the real key here is going to be if the market accepts what the Fed does as not a catalyst for banking crisis. If the Fed essentially comes in and says, here's your 25 basis points, here's a slightly higher terminal rate forecast so that we're consistent with what we've been saying, and so we are reflecting what's going on with inflation expectations and what's going on with Fed rate hike odds, and we say, look, we need to do more, we're going to do more, we're going to do it such that expectations get into 2%, and the market takes this as it did with the ECB and says, okay, we believe you. You can do this without upsetting the apple cart. Well, then the Bank of England has fairly smooth sailing. But if the Fed doesn't, if the market takes whatever the Fed gives them with a level of concern and says, hang on a minute, either you've become too defensive, you've gone soft on inflation. The banking crisis has scared you. Now we're afraid on your behalf that there is much more under the surface here than meets the eye. And not only are not all the skeletons out, but the skeletons remaining to be revealed are of the scarier kind. And that makes for market consternation. Or the Fed goes harder than the market is prepared to digest and accept. And says, okay, you really don't care about banking stability. You're going to hike no matter what. We can't take this risk off. This is going to end in tears. Either one of those scenarios represents a difficult situation of which the Bank of England will be the first test. And whatever happens with the Fed, if the Bank of England wades into a difficult environment, that would stand to substantially amplify concerns one way or another. And so it'll be very interesting to see how they ultimately square this circle. And if, in fact, they do feel themselves ready to deliver one more hike and to take us closer to that 2% inflation target for their own thinking. And that is what is going to be front of mind for us next week. This concludes Macro Money's run for this week. It is Thursday. We are here Monday through Thursday after overtime with our friend Chris Vecchio, head of Futures and Forex here at tastylive. I'll be back with him for Futures Power Hour tomorrow. Macro Money will return next Monday following overtime for its usual schedule. I will also be on, as ever, on First Call with Tom and Tony on Sunday at the APAC Market Open to see how the markets roll out of bed after this coming weekend. Outside of those shows, you can follow me on Twitter for the various thoughts I have intervening at Ilya Spivak. Thank you very much, everybody. Godspeed. Talk to you soon. Take care.